Welcome. Today we will be exploring the difference between FIFO and LIFO inventory valuation methods. Each year, public companies file reports about how they perform financially. These reports are called 10-Ks, and they are mandated by the SEC. It is by these reports that companies remain transparent with the public, particularly investors. For example, for 2022, Amazon reported a total net income loss of $2,722,000 on its 10-K report. This steep number may be a red flag Amazon would really rather not wave. Yet thanks to the SEC, all green and red financial flags hang high for all eyes to see. Now I want you to think of Hershey's chocolate in all its goodness. It is positively delectable, yet destined to expire. FIFO stands for first in, first out concerning inventory, and for many food and beverages like Hershey's, this method seems most logical. In this example, selling the 500 kisses produced first in January guarantees that the chocolate will likely be sold before it expires. Once a kiss is sold, the oldest price per kiss is added to the total cost of sales that will be displayed on the 10-K. If 0 kisses were sold in January and February and 400 kisses were sold in March, accountants would actually report the production price per kiss as 2 cents, given that the 500 kisses made in January were produced first. First in, first out. LIFO is FIFO's opposite, meaning last in, first out. In our example, LIFO makes the assumption that the 550 kisses produced last will be sold first, regardless of distribution sequence and chocolate expiration. Once a kiss is sold, the newest price per kiss is added to the total cost of sales that will be displayed on the 10-K. Of the 400 kisses sold in our example, the production price per kiss recorded would be 1 cent. Yet the flow of recorded costs does not have to match the flow of sold tangible units. Despite chocolate expiration and the fact that chocolate produced first is generally distributed and sold first, the Hershey's Company valued the majority of its inventory using the LIFO method in 2023. Why would they do this? A company can choose either method to manipulate calculations to work in their favor. FIFO used lower recorded costs and higher net income on 10-K statements, making it preferable during inflation. However, LIFO yields higher recorded costs and lower net income, making it preferable when taxes are high. With deflation, the opposite is true. When comparing companies to invest in, the method used is important to take into account. If one company uses FIFO and another uses LIFO, the net income comparison will not be accurate. So the next time you think of investing, think of a kiss.